I think Tom actually hit on a few great points that I'm going to touch on as well, because he spoke a lot about relative strength. And to us, relative strength is really important. It's probably, aside from our PowerGauge rating, is probably the single most important factor that I look at when analyzing the market and different areas of the market and different stocks. And you mentioned Skyworks and Microchip, because I think semiconductors are a really good tell for the overall market. So we're going to talk about finding relative strength and what to buy and sell now. But for kind of before we dive right in, for those of you who don't know, I've been on the street for about 19 years, which is surprising to me that it's been that long, but it has been. I am a chartered market technician, so that means I've passed the 3 levels of the Chartered Market Technician Association's exam and earned the right to use that designation. And I'm also the co-chair of the New York chapter of the CMT Association. It's the largest chapter. I think it's one of the largest chapters in the world. So that's kind of it's a nice honor for me that they asked me to do that. And prior to joining Chaikin Analytics back in March, I spent 10 years on the sell side on a sales and trading desk, covering large institutional investors, mostly mutual funds, pension funds, and hedge funds here in where I am in New York, and also a few one-offs in different parts of the country. So, that gave me a really good understanding about how these large money managers kind of view the market and what their research and analysis process looks like. So that is me by way of background. So really, with the market, the sell-off into December and the sharp rally back, it's easy to get excited about the market. But for us, we're always kind of wondering, where is the relative strength in the market? Because relative strength is what's going to lead to outsized returns. If you think about the large mutual fund complexes, they're all running money based on a benchmark basis, right? So, a mutual fund manager who owns a stock that's up 15%, you might think that that's great, but if the market was up 20%, like, he actually did a terrible job. And the flip side's also true. If he owns a stock and it's down 10%, you say to yourself, wow, the stock is down 10%. But if the market was down 20%, well, then, he did a great job on that pick. And the majority of money that's run in the world is run by, long only managers who are benchmarked to an important index, whether it's the S&P 500 or the Russell 2000 or what have you. So that's why, to me, relative strength is one of the most important factors to look at. But we start with the market, and right now I think that what we're going to be looking at is a key test at the 200-day moving average. I mean, here we have the S&P 500. This chart is actually as of yesterday morning, so we're kind of bumping up against the 200-day moving average right now. One of the things that's interesting to me, that has actually given me a little bit of a pause here, especially as we get to the 200-day moving average, is that we haven't seen a momentum thrust off the lows. And by that, I'm looking at the RSI. And, you can see we got deeply oversold with the sell-off into December. But as we've rallied, and the rally has been strong and swift, there's no doubt about that, but it hasn't been able to produce an overbought condition. Now, a lot of times people say, well, if something's overbought, I immediately want to sell it. For me, I use RSI as an indicator of the strength of a trend. So for me, something getting overbought is not as concerning, because if it's happening within the context of an uptrend, it actually tells me that uptrend is strong and healthy. And if you notice that as the market was rolling over, you notice we were able to become oversold 3 times, but we never really got much above the 50, 55 level on the RSI. Now, we have poked above it, but to get really bullish, I would love to see the market take out the 200-day moving average with some momentum confirmation. I actually want to see the market become overbought in that situation. Now, one of the other indicators that's obviously important is the Chaikin money flow indicator, created by Mark Chaikin, as a sign of institutional buying and selling in the market, and that has been really strong. And you can see this swift rebound here, and part of that has to do with these readings from the steep sell-off rolling out of the calculation. It's a 21-day or a 20-day calculation, but the fact that it's persisted as these down days have rolled off is encouraging to me. So really, for me, I want to see a break of the 200-day moving average, and I want to see that break confirmed by momentum. But we are seeing some positive developments from Chaikin money flow. Additionally, we're starting to see breadth improve. This is the percent of stocks in the S&P 500 above their respective 200-day moving averages. And as of yesterday morning, that was sitting at just over 50%. So a nice rebound with the market. I'd love to see it back over 55, near 60%, to give me an indication that a healthy majority of names within the index are above their long-term trend lines. But breadth is certainly improving. I mean, look at how low we became back in December with that sell-off. So a nice rebound in breadth is acting as a tailwind. And basically, this kind of gets back to a little bit of what Tom was saying, some of the messages that we're seeing in the market right now. When we're looking for relative strength, we do start at the index level. Small caps have actually been leading large caps to start the year. So to me, that's a sign of risk taking in the market. We're looking at the IWM here on an absolute basis. You can see we've kind of punched through the 50% retracement of the entire move from high to low. 62% retracement lines up pretty well with the downward sloping 200-day moving average. So I would expect a little bit of a stall out here in the 155 to 157 area for small caps. But what's interesting to me is here as well is we've seen a little bit more momentum confirmation from RSI. It's slightly better than what we saw in the S&P 500, and we're in the process of breaking this relative downtrend line. So when I look at the relative performance of small caps against the S&P 500 since the beginning of the year, we're seeing some encouraging development. So when I'm looking at relative strength and doing my work, I write a note every day where I highlight a bullish or bearish idea. The fact that small caps are outperforming kind of gets me to gravitate towards the small cap of the market spectrum, if you will. Whereas, throughout a lot of the back half of 2018, we were avoiding small caps, and for good reason. Solid relative downtrend up until just recently. Technology has also been an area of the market that's showing some good relative strength, using the Qs as a proxy. Again, similar dynamic at play, bumping up against the 62% retracement level. Also lines up with its 200-day moving average. Again, not seeing that momentum thrust confirmation that I would like to see, but on a relative basis, we've broken the downtrend line against the S&P 500 and are continuing to move higher. So again, when I'm looking for ideas, bullish ideas throughout my process, this gives me a good roadmap. I know I want to kind of be looking at some of the constituents of the Qs. I want to be looking in the small cap spectrum because that's where we're seeing relative strength at the index level. And then to me, Tom mentioned semiconductors. He talked about Skyworks. He talked about microchip. To me, semiconductors are one of the most important industry groups for the market, and in particular, how semiconductors are performing, again, relative to the broader market. So just kind of using the SMH, the Van Eck Vector Semiconductor ETF as a proxy for the group, you could see that semis topped out well ahead of the broader market. And then on a relative basis, really started to decline back in the June, July timeframe and underperformed the market throughout the rest of 2018, leading into that major sell-off for the S&P 500. But something as interesting happened because as the quote-unquote market was bottoming, semis started to outperform, and you're seeing a nice move higher here with that report out of Microchip and that report out of Skyworks today. RSI for the semis getting close to overbought, so we are seeing a bit of that momentum confirmation. So it looks to me like semis are putting in a relative bottom. So that to me is positive for the market in general. And I mean, if you read any of the transcripts or looked at the notes or listened to the call, Microchip actually highlighted the fact that they think, Tom, you mentioned that they both cut numbers for the March quarter, but Microchip said that they think March is the bottom of the cycle for them. And Microchip actually has a pretty good history of calling the semiconductor cycle because their chips are very pervasive throughout the economy. Skyworks is somewhat limited in that it's very much consumer electronics where their chips go. Microchip's chips go into a wide array of the products that we use on a daily basis, not just our phones and tablets and computers. So if they're calling a bottom here, I tend to listen to them just because, as I said, in my past life, I spent time on a sell side desk, and we had an analyst who covered microchips. So I have some history with that company and their pronouncements about the semiconductor cycle. So this is an encouraging sign to me, again, predicated on the relative strength that we're seeing in semis against the broader market. One of the other things that's interesting to me is that we're starting to see money rotate into emerging markets. Now, some people will read into this that it's basically a valuation trade, that the U.S. is expensive relative to the rest of the world, and in particular, the emerging markets. I can see that argument, but I also view it as a sign of risk appetite for investors. So again, EEM, breaks out here, takes out the 200-day moving average, a little bit better momentum characteristic than what we're seeing for the S&P 500. And on a relative basis, you can see this one actually broke the downtrend line in mid-November. So, a solid month before the market bottom. So I do think that there is an element of risk seeking going on in the marketplace right now. And you can it's evidenced in the relative performance of the emerging markets as an asset class. And I think part of that as well has to do with the dollar. The dollar is beginning to roll over here. We're using UUP as our proxy for the dollar against a basket of currencies, and kind of topped out in early December, going lower, testing the downward sloping 50-day from below, still above the 200-day moving average. But if we look at the RSI for the UUP, we can see we had the negative divergence at the top where price made a new high, but the RSI did not. And we've had just a series of lower highs on RSI. So it looks to me that the momentum is shifting for the dollar. And to the extent that the dollar continues to go lower, I think that that's going to be another tailwind for emerging markets, which we can see here. Dollar strength throughout most of 2018 led to emerging market underperformance. And now as the dollar is rolling over, we're starting to see some outperformance from the emerging markets. And I also think that that's a function of rates heading lower as well, at least the impact there on the currency. Tom, you mentioned the 10-year yield. I think that the path of least resistance for the 10-year yield is lower. Just based looking at the technical picture here, you can see there's solid resistance right around the 2.8% level. TNX below the 50-day moving average, below the 200-day moving average. I would not be surprised to see support give way here, and for us to maybe pull back and test the 2.45 to 2.5 area on the 10-year yield. And what's driving that view is our momentum work. You can see that RSI has shifted into bearish ranges, and this is again what I was talking about. The fact that it was able to become as oversold as it did back here towards the end of the year, and on subsequent rallies can't retake the 50 level, to me that's a sign that momentum is shifting to the bearish side of the coin. And I think it's likely to continue, and increases the odds that we are going to break lower. And as yields do break lower, we're going to start to see utilities outperform. And this kind of gets back to a little bit of the mixed message of the market that we were talking about, because utilities are traditionally viewed as a defensive sector. But if we look at the XLU, you see a nice uptrend, held the rising 200-day moving average, and now beginning to move higher again. RSI not quite where I want it to be, but on a relative basis, holding above support against the S&P 500. So the XLU, I think the last time I was on the show, we were highlighting the defensive parts of the market. So they did their job through the market downturn by outperforming the market, now giving a little bit back. But I think as long as we hold above this support level on a relative basis, I think it's a continue to be a good idea to isolate some names within the utility sector, and that goes for real estate as well. I mean, we have a breakout in the REITs, looking at the XLRE ETF, taking out this 34 level, and this is really a great example of what I'm talking about and what you want to see as key resistance levels are broken. Notice that the XLRE was able to become overbought here, so a momentum confirmation to the breakout, and still in a nice uptrend relative to the market. So real estate and utilities outperforming is kind of the monkey wrench, if you will. If you really want to get super bullish on the market, you have to ask yourself, well, why are these traditionally defensive sectors outperforming? It could just be a function of rates. But again, if everything was solid, Tom, you and I were talking earlier, if everything was all systems go, you would actually expect rates to be moving higher, and rates are moving lower. So I think to the extent that rates continue to move down, which I expect, I think you can still favor these defensive groups like utilities and real estate, because they are exhibiting the types of relative strength that we're looking for. Now, Tom, you mentioned the VIX as a sentiment indicator. I obviously look at the VIX as well, but I also like to look at the CNN Fear Greed Index, and sentiment is turning bullish. So sentiment is not as much of a tailwind now as it was when we were coming off the lows. We're kind of at a 64 level, just getting into the greed portion of the index. Back at the end of December, we were actually down here in the low single digits. So that, sentiment really did provide a solid tailwind for the lift that we're seeing in the market. I mean, we've gone from extreme fear to now greed in a little over a month. And they kind of asked the question here, what emotion is driving the market? And for us, it's an interesting question, but not asked the proper way, because the way we view the world, fundamentals actually drive the market. And, I'm a technician first and foremost, but I do believe in fundamentals. I think that, you want to be long stocks with solid fundamentals and then use technicals to buy them the right way. So we do believe firmly that fundamentals drive the market, and it's our emotions that drive the market to extremes. And what we like to do is combine the fundamentals with technicals to give us the best opportunity to outperform. And we want to take our emotions out of the equation as much as possible. And the way that we do that is with the Chaikin PowerGauge rating. It's a simple but powerful tool. Kind of looks like the gas gauge on your car. Rates stocks between very bullish and very bearish. And, for me, especially at all times, but especially when the market's really volatile, I like to think of it as a GPS for the market. So basically what it does is it looks at 20 factors on a daily basis, from financials to earnings to technicals to expert opinions, and rolls all those up and gives every stock a rating from either very bullish to very bearish. And what really intrigues me about it is these factors are the factors that my former clients, mutual fund managers and hedge fund managers, look at on a daily basis. And they spend a lot of time modeling it out and trying to get an indication of where these numbers are going to, as they're making their, decisions of, what to be overweight and what to be underweight within the market. So we combine them all into this one model and do all of the research. We do all the research for you. And what's interesting is it's not just a value approach or a growth approach, right? We look at the key value factors like debt to equity and price to book and price to sales. But then we also look at the key factors that growth investors look at, right? Earnings growth, earnings surprise. Does the company have a tendency to beat expectations, or do they miss expectations? How have earnings been trending over the, short term as well as the intermediate term? Obviously, technicals are important to us, looking at the typical trend and momentum factors that technical analysts look at. And then the secret sauce is really in the expert opinions. What are analysts doing with their numbers? What are analysts doing with their ratings? What are the insiders doing? So when we roll all that up, we take these 20 factors and we come out with a clear, concise indication of a stock's likely potential over the next 3 to 6 months. And the reason I like the model approach is really can be summed up in one sentence from a very prominent money manager, Jim O'Shaughnessy. Models beat human forecasters because they reliably and consistently apply the same criteria time after time, as opposed to us humans who are swayed by our emotions and our opinions, right? We try to take the emotion out of the equation as much as possible. We know that sometimes that's hard. We all get emotional, especially when we're investing, but to the extent that you can take your emotions out of the equation, it's really beneficial to you. So starting from the top down, we looked at the market, but we have an interesting way beyond just relative price strength of looking at what's likely to outperform and what's likely to underperform. And we call it the Chaikin power bar ratio. And basically what we can do is we look at all the sectors of the market and all of the key industry groups, and we can see within each sector and key industry group how many stocks are currently rated bullish or very bullish, that's in green, how many are neutral, and how many are bearish or very bearish, right? So that gives us kind of a hunting ground, if you will. If we're looking for long ideas, we want this ratio to be skewed to the bullish side, and we want it to be stronger than that of the S&P 500. So kind of a different take on relative strength. And when you combine the two, the ratios with the price performance, you really increase your odds of finding winners as well as finding names to avoid. So, we touched on the utilities, which have been outperforming. You can see 11 bullish stocks and 0 bearish stocks, right? We touched on real estate, 6 bullish stocks and 2 bearish stocks. And so once we've kind of identified the key sectors of the market, we can then drill down to the industry level. So we see financials, right, is the number 2 sector based on this metric. And if we look within the financials, well, where do we want to focus our attention? Well, insurance, the large banks, as well as the regional banks are basically showing the strongest ratios based on our model. So we start with the market, we look at the sectors and then the industries, and then drill down to the individual stock level. So tech, right? Tech was outperforming the market, 20 bullish stocks, 8 bearish stocks. What I see here is tech is really trying to recover. Looking at the market the way that we do, our relative strength indicator, you can see that it's working its way back up towards outperformance. Not quite there yet, but something to keep an eye on, especially in light of that bullish ratio that I just showed you. You can see that money flow here has turned positive. We have a shorter term overbought, oversold indicator that we use. It's a stochastic of MACD. And what's interesting to me is that it never became oversold and is beginning to round higher. So to me, that's a sign of underlying strength. So when I see that bullish ratio and I see the relative performance starting to improve, I want to do work on the technology sector and look for the industry groups within technology that are really showing relative strength. And the one that jumps out at me is software and services, which has been strong. And now we've actually recently started rating ETFs. So this is the XSW. It's the software and services ETF, and it has a very bullish rating. And we can see here it's outperforming the market. Money flow is solid. It's retaken our long-term trend line and moving higher, right? So as I roll it down, tech is starting to improve. Software and services outperforming. Well, what are some of the names that I want to consider on the long side there? A name like Synopsys jumps out at me, and just kind of putting that under the StockCharts.com lens, we can see a nice breakout through resistance here, rising 200-day moving average. And I use the scooter line as my gauge of relative strength. And you can see here, this was as of yesterday, a reading of 88. So solid outperformance combined with Chaikin money flow in a leading industry group type of name that I want to be long. I actually had the honor of writing Mark Chaikin's Market Insights note this past weekend, and this was my bullish stock of the week. So just a little bit of my process and how I go about stock selection. Another name within the group 2 weeks ago in his Market Insights newsletter, Mark called out Cadence Design, right? Similar dynamics at play. Breakout through key resistance, so we can combine our traditional technical analysis, but we know the fundamentals are good because our model is bullish on Cadence. So the breakout, solid outperformance based on scooters, solid Chaikin money flow, type of name we want to own, leading stock in a leading industry group. Financials are another group that we're watching closely, right? We saw the ratio. It was the number two sector. Bullish ETF rating, beginning to outperform the market with bullish money flow. Now our indicator here is oversold, so could be an opportune time if you trade ETFs to potentially look at the XLF as it's beginning to outperform. But if you want to take it a step further and look at the industry level, we highlighted that insurance was the top industry group. So KIE here, our proxy for the insurance industry group, showing some good outperformance. And we look at a name like Aflac. This was actually my bullish stock of the day in my note to clients today, breaking out, solid scooter score, money flow starting to turn bullish. So a name like Aflac, based on our process, backed up by the PowerGauge rating, really gave me confidence to go out and make that our bullish stock of the day. The flip side is, where are we seeing weakness? And consumer staples did a great job as a defensive group when the market was selling off. But now as we're rallying, relative strength in the staples is actually beginning to turn lower. And you can see our ETF rating here is neutral on the staples. So I think staples are on the verge of going to start to underperform the market. And one of the areas, one of the stocks that kind of jumps out at me as a potential bearish candidate, or if you long it, a source of funds, is Costco, right? Breakdown, rally back to the 200-day moving average and beginning to roll over again. But look what's happening with Scooter here. Underperforming the market. This trend of outperformance has now turned to a trend of underperformance. So this is a name that we certainly want to avoid. When I look at an industry group, food and beverage on the verge of breaking down on a relative basis. Notice that money flow has stayed pretty bearish throughout most of the time frame. The persistency of money flow has been bearish since July. So the food and beverage stocks, that's an area that I would avoid, or potentially, if you trade to the bearish side, look for opportunities when they present themselves. This was actually a recent name that I highlighted as a bearish idea. It's Boston Beer, the makers of Sam Adams, very creative with our ticker symbols here. This is a stock that, is bearish to me, broken through the 200-day moving average, moving sideways just a bit, but look at how it's performing on a relative basis, really starting to underperform the market with a big character shift here. We've gone from solid Chaikin money flow, solidly bullish Chaikin money flow, to now a lot of bouts of bearish money flow. So that tells me that institutional investors are coming out of this stock. And if you're long it and you've been long it this whole time, I think it's a good opportunity to take some money off the table. And if you do trade to the bearish side, I think you want to potentially look at setups to take advantage of further weakness in Boston Beer. So again, the PowerGauge is what drives everything we do, from a stock selection level and now even from an ETF level, because it gives you it puts the odds in your favor. We know that our very bullish and our bullish stocks are likely to outperform the market. We know that our bearish stocks and our very bearish stocks are likely to underperform the market. So as we're doing our relative strength work, we use that in conjunction with the PowerGauge rating. We actually have a product that I think is a great complement to StockCharts. It's called our Power Pulse product, which gives access to the PowerGauge rating for different stocks and ETFs. And just kind of by way of example, Apple, right? Everybody's darling for a long time. Our PowerGauge rating actually turned bearish on Apple up here around the 210, 215 level before it really started to roll over. So having that rating, gave our clients a great opportunity to sidestep this leg lower. And you can see it started to underperform the market shortly thereafter. And just like when we saw it on the charts here is where the rating turned negative. But at the time, the stock was still outperforming. So the PowerGauge rating can really help you sidestep the landmines that are going to blow up your portfolio, and also just kind of tilt the odds in your favor when you're looking for long ideas. And with the Power Pulse product, you can set up your portfolio and monitor it, and every day you'll see what the PowerGauge rating is for the stocks that you're watching or the stocks that your portfolio. All of the research is done for you. We crunch the numbers every night, and the ratings update early the next morning. And in addition, you get Mark's weekly market commentary. It comes out Sunday afternoons from time to time. I write it as well. But it's in that commentary where we kind of give you everything you need to know for the week ahead. And we highlight bullish or bearish ideas on the bullish side, for instance, like Cadence or like a synopsis. So when I knew I was coming on the show today, I really feel so strongly about the PowerGauge rating that I got the team to offer up a special deal here. You can try Power Pulse for just $10 for the first month. after which it would renew at the regular discounted price of $24.95. It's a special that we're running for the StockCharts.com community. And if you're interested, you can head over to our site, ChaikinAnalytics.com/StockCharts to sign up. So that's those are my thoughts on the market, and I'm here for any questions. I love the Q&A.
All right, perfect. That was a great presentation. Thank you so much, Dan. There are a couple questions here.
Great.
One was just relating back to what you had talked about, the New York chapter, the CMT. Somebody was asking how many members are in that chapter. Do you know?
I don't know off the top of my head how many. I can certainly find out and get that information to you. I do know that it's one of the largest chapters in the world, as you would expect with a lot of the financial professionals that are located kind of in the tri-state area here. But I don't know the exact number.
Okay.
I also grade the level 3 exams for anybody who's interested in joining the program.
There you go. Do they get a special grade if they sign up for your Chaikin Analytics?
I cannot comment on that.
Sorry, I just had to throw it in there.
No, we actually, the folks who took it actually just found out last week what their results were. So some excited friends out there.
Yeah.
But no, we don't actually know whose exams we're grading. As you would imagine, they're coded, and obviously they don't tell us whose exams we're grading.
Yes, of course. I was just joking. All right. So another viewer asked, how important is the Chaikin oscillator to use with the CMF? The viewer uses them both together.
I think that anything that you can use that gives you confidence in your analysis is important if it works for you. The Chaikin oscillator is not as widely used as Chaikin money flow. But I think like any other indicators, you kind of, they tell you a story, right? So when the indicators line up, that should give you more conviction than when the indicators are in different directions, right? So if I'm thinking about how I look at a stock, right? I want stocks that are outperforming the market. I want them when they're oversold. I want a bullish or very bullish PowerGauge rating. So when all of those are in gear, my conviction level is higher. But if maybe 2 of those are positive and 2 of those are iffy, I might look for a better opportunity somewhere else. So, I don't think what you use is as important as how you use them and the story that they're telling. If everything lines up, that should increase your conviction level. If, it's like a weight of the evidence approach, if you will, right? If you have a checklist of 5 things that you look for before you buy a stock or an ETF, and all 5, and you can check the box on all 5 of them, to me, that's a high conviction trade. If you can only check the box on 3 out of 5, maybe you want to look somewhere else. Or maybe if you really want to put the trade on, maybe you don't put on your full size. Maybe, you put on a half a position and see how things play out. So I think it's more important to get confirmation rather than the indicators that you use. I think as long as you're using indicators that, number one, you understand how they work and why they work, and you're comfortable with them, from there, I think I like to, I tell our clients, make a checklist and take a weight of the evidence approach. If you can check whatever it is, if you can check all the boxes, that's a high conviction trade. If you can't check all the boxes, then you have to adjust your conviction level.
Yep. All right. I've got 2 more questions, quick ones. I'm going to go ahead and take the screen. But before I do, I just want to remind everybody, you can go to www.ChaikinAnalytics.com/StockCharts for the special that Dan has up on the screen. So let me go ahead. I want to show you a chart here of the SMH, Dan. Because the question is, and you talked about this, you said that you really like the fact that semiconductors, or you like it when semiconductors are strong. It's a really important part of the market. So one of the viewers pointed out that the SMH right now has the RSI up at 69, almost to 70, and you can see across this chart over the last several months, we have not been to that level. So would you would you come to the conclusion, based on the way that this SMH is trading, that this overall is very bullish for the market going forward?
I think it is. More important than the SMH for me on an absolute basis is how it's performing on a relative basis, which I showed on the chart as well. But it's interesting to me, right? Because while it was, from kind of September, October, November, as it was in a downtrend, notice that the RSI never became overbought, right? To me, that tells you that that's a strong trend, right? I don't use RSI in the traditional sense of, sell at 30, sell at 70, buy at 30. I use it more as confirmation of the trend. So when I see it's not able to become overbought, that tells me that downtrend is strong. I actually am encouraged here that the SMH is on the verge of becoming overbought, because it tells me that this emerging uptrend likely has legs. And you can do the same analysis. You can do the same analysis here on the relative chart, right? Tom's put up SMH relative to the SPX. You're seeing a similar dynamic at play. Notice that through the entire time it was underperforming, it never became overbought. In fact, it had a hard time in most cases getting above the 50 level, right? It wasn't until that spike in November that it took out the 50 level. Now it's finding support at the 50 level and on the verge of becoming overbought. That is a signal to me that this emerging trend likely, right? Nothing's absolute or for certain, but that this emerging trend likely has some legs to it.
Awesome. All right, one last question, and that is, I'm going to pull up the dollar chart here first, because the question that came in was, given the dollar's weakness, I'm paraphrasing a little bit, but the dollar topped back in December. You can see these tops here, and it's been mostly in decline for about the last 7 or 8 weeks. The question is, with the dollar weakness, and you talked about the EEM, but what about gold? Because gold has been so strong. Do you think that this weakness in the dollar will continue to provide this momentum that gold has been seeing?
I think it could actually. I mean, I didn't touch on gold here. I mean, I could sit here and go all day with the charts that I look at and what's interesting to me. But what I will say is, to the extent that the dollar continues to underperform, that's obviously a tailwind for gold. And if you're curious on what my position on gold is, I was actually I was on Bloomberg TV about a week and a half ago on one of their segments called Futures, Charting Futures, where I talked about gold as my bullish idea. So I think it's a little bit overdone here in the near term. At the time, I was talking about a breakthrough 1300, likely targeting 1360 in the near term. We broke through 1300, and we're kind of pulling back. So from a trend perspective, I still like gold. Don't necessarily know if I would chase it right here. But yes, I think that way of looking at it is correct. To the extent that the dollar continues to weaken, that is a tailwind for gold.
And I just pulled up the longer term chart here just to show that overhead resistance you were talking about.
Yeah, right there at the 1360 level. But you can see it's a solid run. I do like gold. I do think, as I said, the path of least resistance is lower for yields. So that should kind of spill over into a weakening dollar and be a tailwind for gold.
Okay, awesome. Always,
again, your time frames matter, right?
Absolutely.
I think if you're trading for the next 3 days, I'm probably not chasing it here. But a pullback to that 1300 area sets up a great opportunity, especially with the moving averages just below. You're looking at a 20. That's a 20-day moving average. So you probably line up with 1300 on a pullback. I think it would be a good opportunity.
Yeah, certainly would reduce the risk of a trade down at that area. All right, always a pleasure to have you on here, my friend. We get so much information from you. Your relative strength presentation was awesome. We look forward to seeing you again.
Thank you so much for having me, and thank you everybody for taking the time to listen. I look forward to coming back soon.
Sounds good. Take care, Dan.
Thank you.
All right, there he goes. Another great presentation by Mr. Russo, talking a lot about relative strength. Of course, that's what we talk about a lot on here, and I think it's really important. It's a big part of technical analysis, and I think one of the things that Dan touched on earlier in his presentation, talking about how, if you've got a money manager who's up, 20%, and the market's only up 15%, you might say, hey, 20%. Pretty good. Well, it's actually really good if the benchmark's up 15%. On the other hand, if the benchmark's up 15%, you got a manager is doing 8-10% for you. Well, you could put your money in the SPY and earn 15%. So that kind of underperformance, not very good. But relative strength is the key. I always say my goal is to try to outperform the S&P 500, and it's really difficult to do that if you're in areas of the market that are underperforming.
I want to show you a little charting trick that I like to use for the percentage price oscillator, or the PPO. On this SPY chart here, you can see in the indicator windows, I've got 2 PPOs. The first is the traditional PPO. It's the black line there, and that's the difference between the 12-day EMA and the 26-day EMA. And you can see it's above zero when the 12-day EMA is above the 26-day EMA, and below zero when the 12-day EMA moves below. The red line is the signal line, and it's set at 9. So it's a 9-day EMA of the PPO. And you can identify downturns and upturns in the PPO with that EMA. And the histogram is the difference between the PPO and its 9-day EMA there. You can see when the PPO is below its 9-day EMA, the histogram is negative. And then when the PPO is above its 9-day EMA, the histogram is positive. Now, the little trick I want to show you has to do with the PPO 50, 200, 0. That's the second indicator there. And what I've done is I've eliminated the signal line by putting 0 as that last parameter. So this PPO shows the percentage difference between the 50-day EMA and the 200-day EMA. And you can see that it shows as a histogram when using these parameters, and it has been positive for over 6 months, actually for over a year, actually for over 2 years in this chart. And we can see that it's currently around 3.1% difference. That means the 50-day EMA is 3.1% above the 200-day EMA. And we can confirm that by going to the annotate button there and choosing percentage change. And if you measure the percentage change from that 200-day EMA, the red line, and I go up to the 50-day EMA, there you can see we're about 3.1% difference. And so that's what the PPO is telling you. And so I like to use that longer term PPO to get an idea of the long-term trend.
Hi, this is going to be a quick 2-minute video about how to put industry groups into your chart lists or make a separate chart list for an industry group. First of all, clicking on Advanced Scan Workbench. Second of all, scroll down here under the Stand Components, and you can either pick US or Canadian. I'm just going to pick Canadian because it's not the default, but obviously if you did the US, you'd just go the same way. So you're going to pick Canadian, and in this particular case, we want to find healthcare. It's a group that's doing pretty well. So you could either do the individual industry groups, or in Canada's case, the healthcare sector is less than 60 stocks. So we could add them all. So we put it in there. Don't forget this add button shows up as a line up here. Then you run the scan, and then available actions. You're going to go in here and store these results in a new chart list. You can name it whatever you want. I have a particular naming convention that I like to use that I described in my book, and it is to put the H in there for an alphabetical sort, and so I'm just going to say Healthcare Canada. And with that, that puts it into an industry group list. And you can see here's all my industry groups. I've got other ones in here. But the bottom line is then that way you can sort them and do whatever you'd like. So in this case, they're sorted by scooter ranking, and then you can also look at them by intraday, 1 week, 1 month, and you can also say hide other columns. So with that, I'll leave it. But in general, that's how you can quickly get industry groups into a single chart list. Thanks for taking the time to join me.